Good morning. It's Jeffrey Christian of CPM Group. It's about 10:50 in the morning on Tuesday, the 10th of September here in New York. I want to talk about gold investment demand and central bank demand now as it's running. Give you an idea of the flows. As you may know from CPM Group's half a century of analysis, our view is that it is stock demand, a demand for gold for stocking by private entities, investors, and monetary authorities, central banks and monetary authorities, treasuries and ministries of finance, that really determine the prices, directions, and levels for gold. So it's very important to catch on here. Gold, as I speak, it's at 25.38. It's been trading sideways around 25.50 over the last couple of weeks. Seems to be building a base. There's a tremendous amount of anxiety about the political environment, both in the United States on a global basis and in various other countries. There's also a lot of uncertainty and about the direction of economic conditions as well. And this is probably going to continue to keep the price of gold strong for a while, and possibly push the price higher over the next couple quarters. I wanted to show you this. This is a longer-term chart. Now, when CPM Group does its research, we do a lot of fundamental research, and we cobble up statistics and estimates of supply and demand from around the world for each commodity that we do research on. And we marry this microeconomic view and analysis of the market with a macroeconomic, political, economic, and financial top-down model. And that gives us a longer-term view of where we think the prices and markets are going. Then we add in shorter-term fundamentals that don't necessarily show up in annual supply-demand data. And we modify that longer-term view, and it gives us, we can distill it down into our shorter-term views. 1 month, 3 months, 2 years, 3 years, that sort of thing. We do look at technical analysis because 99% of the trades in gold and silver and oil are based off of technical analysis of one sort or another. One of the things that we found that has worked very well, technical analysis, it's the KISS. Keep it simple and stupid. The most obvious technical chart patterns, price patterns, are the ones that have the most followers, and they tend to become self-fulfilling prophecies. One of the ones that we found that has worked since we've been looking at them in the mid-1970s is a measured move. You have an upward or downward move of a certain size, then you have a 50% retracement, and then you have another upward move. We've talked for several decades now about a measured move in the gold price that really, in our view, started in 2000, 2002, and had the first leg peaking in 2011, came down to 2016 or so, and then has started a second move. But within that broader, longer measured move, you can have shorter ones. And if you look at the price chart since 2014, first off, you see that consolidation after the price came off from 2011 into 2013. And the price basically traded between 1,200 and or 1,100, 1,150, 1,050, and 1,400 for about 5 years. Consolidated. It started to move up again in early 2019. You had an $800 upward leg for over 2-year period from late 2018 into into the middle of 2020. $800 up. Then you had a $400 move over the next 2 years down to about $1,640. And we have since that time risen up to about 2,500. A technically oriented investor or trader might say, okay, we're in the midst of a second $800 upward move. That first upward move and the consolidation period. Each lasted 2 years. So we would talk about a 2-year $800 second leg. That second leg would have started in November of 2022 at 1640. It would have an objective, if my math is correct, of 2,840. And it would have a temporal objective of the fourth quarter of this year. I'm not saying that we agree with it, but that happens to coincide with the economic and political and fundamental analysis that we do that gives us our longer term views. And I just wanted to point this out because it's a very strong measure, because it is so obvious there are a lot of people in the market investing and trading based on this concept. Silver prices came up. They have come back down. They are struggling as we speak to get over $29. The price got up as high as, this is for the December COMEX futures now, the price got up as high as $28.89 earlier today. It's trading on $28.68 as we speak. I hope to talk about silver in the same fundamental depth that I'm going to talk about gold today. I hope to talk about silver soon in the same level. But let's talk about the fundamentals. Before I do that, here's the US dollar. And I keep hearing people talk about how the dollar's tanking and how people are dumping the dollar. The dollar is actually up 0.4% from where it was a year ago. On Friday, September 6th, it was up 0.4% from where it was a year ago. That's not exactly a collapsing dollar. And it's up 2.6% from where it was at the start of this year. So I think if you're a rational investor, you may safely ignore anyone who tells you the dollar is tanking. You don't have to listen to him. You don't have to base your worries about the state of the world on what he's saying. And you definitely don't have to vote for him. Now, investors are buying a lot more gold this year. As I said, they're concerned. There's any number of reasons. Politicians around the world are working very hard to give us all very good reasons to want to own more gold. This is a very concerning time. Investors are probably going to buy about 32 million ounces of gold this year. That's that black bar on all the way on the right here. That's up, for the last 3 years, we've seen 24 million ounces in 2023. 25, 26 million ounces in 2021, 2022. During the pandemic and economic lockdown, investors' demand spiked up. It went from about 17 million ounces in 2019 to 39 point something, almost 40 million ounces in 2020. That was the fourth largest net investment demand on an annual basis in history, going all the way back to 1967. It came down in subsequent 3 years. It's picking up again. Our expectation is that it's going to stay strong through the rest of this year into next year. We actually have a higher number, I think, for net investment demand next year than we do for this year. We're not looking for a peak in the gold price in November, the way a measured move technical analyst might be looking. We're looking for gold prices to move further higher next year. And it will be inspired and supported by higher investment demand. So this is physical demand. This is demand from investors, not central banks, investors for physical gold on a global net basis. Some investors are selling, gross sales. Some investors are buying, gross purchases. And this is the net as we projected for this year and as we have estimated it since the 1960s. If you break that down, investors are buying gold ETFs. For 3.5 years, they were net sellers of ETFs. You can see this from 2020 into the early part of this year. But as the gold price started rising after April, you started seeing investors saying, how do I jump into gold exposure? How do I buy either physical gold or at least exposure to rising gold prices? And the cheapest, most efficient, fastest ways of doing that is to buy gold ETF shares or to buy gold futures or options. So we've seen an increase since April in gold ETF holdings. These are a lot of, well, some of it are long-term investors who are just added to their positions, but a lot of investors who had gotten out of gold, they were no longer long, they had sold over that 3.5 year period, they were buying again. And others who had probably never invested in gold saw the rising gold prices, heard what was going on, took a look at the world, went to the grocery store, bought some gasoline, paid their child's tuition and said, I think I should buy gold. And they came into it. This is a very quick way to buy into a rising gold market. So we've seen very strong demand. And I should point out, it's really global. It's around the world. In China, much of the gold that's been flowing into Hong Kong and China is going into jewelry and investment demand throughout Asia. Hong Kong is an entrepreneur not just for China, but also for, to some extent, South Korea, North Korea, Japan, Taiwan, Philippines, Indonesia, Malaysia, Australia. It services Asia. And we've seen a lot of gold flowing into Hong Kong. It doesn't necessarily go into China. And it isn't, as some promoters say, going into the People's Bank of China. It's going all over the place. 1.5 million ounces of it over the last year and a half have gone into Chinese ETFs. You can see the Chinese ETFs really started around 2016. They got up to about 2.4 million ounces in 2020, 2021. There was a sell down over the course of 2022. They bottomed out at the end of 2022. Since the beginning of 2023, the amount of gold held by Chinese ETFs has more than doubled, from 1.5 million ounces to about 3 million ounces at the end of August this year. And as you can see at the bottom of this and other charts, most of the charts in my presentation today are in the precious metals advisory that we distributed to our subscribing clients last Friday, the 6th of September. But you're seeing that Chinese investment demand is taking many forms, including physical metal and other, the Shanghai Futures Exchange positions, but it's also going through ETFs. And we've seen a doubling of the amount of gold held by those Chinese ETFs over the last 20 months. You've also seen investors pour into gold futures and options. Again, it's a quick way to buy exposure to rising prices. You've seen a sharp increase in the gross long positions, the orange on this chart. You've seen a sharp increase in the net position, which was down below 15 million ounces not too long ago. It's close to 30 million ounces now. So there's a lot of demand for gold in the futures and options markets. And you've seen a sharp decline in the gross short positions, which went from 15 million ounces not too long ago to about 5 million ounces or less now. Now, there are people who will decry the existence of futures and options in the gold market and the silver market because they really don't understand finance. They should be happy that futures and options exist because this is a tremendous amount of demand for gold, futures, and options on a leveraged basis from investors who probably would not be buying physical gold and paying full price 100% if they had to. If the futures and options didn't exist, they probably wouldn't be involved in the gold market for the most part. And there'd be a real problem for producers, refiners, processors, traders, merchants, and industrial users as to how to hedge their gold price exposure. So don't decry futures and options. They make the world go round. Investors are not buying U.S. mint gold coins. U.S. mint sales to dealers of gold eagles and buffalo coins are off 64% this year through August. The blue bars are annual or monthly gold purchases. I'm sorry, these are annual, these are not monthly. These are annual purchases, and the blue bar for 2024, you can see that is year to date through August. And the red bar in 2024 is last year's number. We're off 64%. Investors are buying gold around the world. They're buying gold in all kinds of forms and media, but they are not buying as many gold eagles and buffaloes. They are buying them, but there's also selling of them so that the secondary supply of resold older eagles and buffalo coins are meeting a lot of the new demand for buffalo coins and U.S. coins. Now, turning to central banks, meanwhile, they have continued to buy gold, although not at the rate that gold promoters suggest, and it has come down a little bit. These are annual gross purchases, gross sales, and net sale purchases. The net purchases are the green line. There's some of the promoters persist in using data that they know is wrong. They just can't admit that they were wrong on data. But you can see here that there was a very strong increase in central bank purchases around 2014. And it's come down, and it's ranged basically between 10 million ounces and 21 million ounces since 2014. There was not a record volume of gold purchased in 2022, the way some gold promoters say. And they know they're wrong. That's their problem. This is the monthly data, and you can see a decline really since the middle of last year. Central banks have some price sensitivity. They're more value investors than private investors are as a group. Central banks have responded to the rising gold prices, especially since April, by scaling back their purchases. And then you can see here the last three bars are May, June, and July. And you can see that the gross purchases, the orange bars, actually were less than 1 million ounces in each of those months, and you actually had net sales in each of those months. Central banks through July, the most recent data, have purchased about 3.7 million ounces of gold on a net basis. That's down 23%. It's off 1 quarter from 4.8 million ounces in the same period of 2023. So central banks are still buying, but the buying has cooled off. One of the big factors is that the People's Bank of China has not added any gold to its reserves since April. It is price sensitive. It was buying a lot of gold. It started buying gold in November of 2022. After a several-year hiatus, it stopped buying in the middle of 2019. When the price got back down to $1,640 in early November of 2022, the People's Bank started buying again, and they bought again into April of this year. But when the price spiked higher in April, they have pulled back since that time and haven't been adding gold to their reserves. You also may safely ignore promoters' hypotheses of secret PBOC purchases and secret Russian trades. That's not actually how the People's Bank of China or other central banks work. It's the stuff of somebody's imagination. Russia has been selling its gold, the Central Bank of Russia, but it sells to private equity entities. It's using its gold reserves to pay for imports and to pay for armaments and ammunition and drones. So it's not using these gold reserves to skirt sanctions and trade with China necessarily. Some of those private entities probably are Chinese. Every piece of evidence suggests they are. But you can see that since Russia invaded Ukraine, its gold reserves and its purchases and sales have fluctuated sharply because gold is the monetary reserve asset that it has available to finance its operations. And, its operations have suffered mightily economically, both in terms of the public uh, expenditures and revenues, as well as the private sector. So Russia has been using its gold to keep itself afloat during its war with Ukraine. That's all I have for now. Thought. We will have an open question and answer session, our open forum, next Wednesday for our clients at 11 o'clock. You may sign up at info@cpmgroup.com. If you are a client, you may send questions in ahead of time. We've already gotten some really interesting ones that we'll respond to. You may also, if you're a client and you're on that session, there'll be a way that you can ask questions during it. We like to get a give and take going on that. If you're not a client but you want to participate, contact us at info@cpmgroup.com and say, how do I become a client fast? That's next Wednesday, the 18th of September. You can go to our website, you can buy our yearbooks, you can see all sorts of other free reads, and you can learn about how CPM Group might help you manage your exposure to precious metals and commodities. Take care of yourself. I'll talk to you on Friday. Take care of those around you. See what you can do to make the world a better place, and we'll talk then.